Today, the bank lowered the policy interest rate a further 25 basis points, bringing it to 2.25%. This was our second straight cut and reflects ongoing weakness in the economy and contained inflationary pressures.
Well, the Bank of Canada did it again. We got another rate cut, 25 basis points, or what I like to call a soft whisper of relief. Sounds like good news, right? Maybe. Well, it actually all depends on how you look at it, because on the surface, you're thinking, great, slightly lower payments, a bit of breathing room. But when you zoom out, you start to realize this isn't just a wobble in the system. It's a structural issue. And those aren't my words. They're the Governor Tiff Macklem's words. Yes, the guy at the top. He actually said it in plain English. This isn't just a downturn. It's a structural shift. And honestly, he had a lot to say, or maybe not nearly enough. Because after hearing him, you're left wondering, how much worse is this going to get? I'm Linda, one of the Ragona Sisters, and in this episode, we're dissecting the news that most of us saw coming. Is this just another tiny rate cut, or is it a signal of something much bigger? So make sure to like, share, and subscribe because I'm not here to sugarcoat headlines. And sometimes I get comments accusing us of fear-mongering. It's not fear, it's actually facts. If the truth feels scary, I'm very sorry you feel like that. But this channel, it's here to help you stay informed with the good, the bad, and the darn right ugly. Because there's definitely ugly. Because that's how you make the right moves, whether it's your real estate, your investments, or maybe it's just your peace of mind. Take a look at this chart. Now tell me, does that look stable to you? From 2020 to early 2022, we were riding the near zero line. Cheap money, easy credit, everyone was buying everything. Then rates shot up faster than we've seen in a very long time, almost 5% by early 2024. And now we're sliding back down again, sitting at 2.25% today. But don't let that little dip at the end fool you. This chart tells a story of volatility, not recovery, because when you raise rates that aggressively, then scramble to bring them back down, it means something underneath is broken. That's the second cut in 2 months. But before you celebrate, consider this. The bank says our economy isn't just weak, it's structurally broken. Let's hear it from the governor's own words.
Today, we also published our outlook for the Canadian economy. Putting those two things together, we have four main messages. First, U.S. tariffs and trade uncertainty have weakened the Canadian economy. We expect very modest growth through the rest of the year, with some pickup in 2026. Second, while this weakness is restraining price increases, the trade conflict is also adding costs for many businesses, putting upward pressure on inflation. We expect these opposing forces to roughly offset, keeping inflation close to the 2% target. And third, to support the economy through this period of adjustment, we have lowered our policy rate by 50 basis points over the last two meetings and by 100 basis points since the start of the year. Finally, the weakness we're seeing in the Canadian economy is more than a cyclical downturn. It's also a structural adjustment. The U.S. trade conflict has diminished Canada's economic prospects. The structural damage caused by tariffs is reducing the productive capacity of the economy, and it's adding costs. This limits the ability of monetary policy to boost demand while maintaining low inflation.
This is not just a cyclical downturn. We're in a period of structural adjustment. So translation, cheaper debt doesn't solve a broken engine. So while variable rate holders might save about $15 per 100,000 of their mortgage depending on their lender and payment structure, that might not be enough to prop up the housing market.
We also saw a pickup in residential investment. Looking forward, we do expect some ongoing resilience in consumption and housing. We do expect consumption to continue to grow. We expect some modest recovery in housing.
You heard modest growth in housing, but let me be real with you. Modest doesn't mean booming. Maybe a bit more activity, maybe a little bounce in some areas, but this isn't 2021 again. And it's definitely not meant to be because affordability is still off. And with unemployment at 7.1%, the GTA is much higher. The average buyer isn't rushing in headfirst. So yes, maybe things start to move, but don't expect fireworks. And according to rates.ca, this 25 basis cut is favorable for variable rate mortgage holders and homeowners coming up for renewal. It's unlikely to spark significant buyer activity. Why? Because even with the home prices down 10 to 20% in many areas, they're still out of reach for a lot of Canadians. Income levels simply haven't caught up. That's the truth. And many have lack of confidence in the economy, and that's very real. And with Doug Ford's recent ad move, things got shaken up all over again. The housing market is not moving in lockstep with interest rate cuts anymore. Times are different. So if you're waiting for rates alone to bring buyers flooding back in, don't hold your breath on that one. We're not just fighting inflation here, but we're also trying to support a weakening economy. Some speculate a continuing of weakening of prices. And let's add purpose-built rentals are on the rise and population growth, well, it's slowing. And this translates to rents easing as well. There's also the tariff issue, the big bad wolf. The bank admits that it's slashing Canada's productivity capacity. So yes, rates are falling, but building costs are still rising. That's why I said don't celebrate just yet. In fact, we're now entering what the bank calls a structural adjustment. They're warning that GDP will be lower than expected by the end of 2026. That's just not growth slowing here, guys. It's the whole economy shrinking in capacity. So what will Canada do? Will they bring in more people just to prop up GDP again? Because let's be real, that's been Canada's go-to move for decades. More people, more demand, more short-term numbers to flash in a report. But at what cost? If the core economy isn't producing more, if wages are flat and productivity is falling, stacking population on top of that isn't a solution. It's a delay tactic, and it could be catastrophic. And here's what I tell my clients. If you can afford to buy and stay long-term, you've got leverage right now. But this is not the time to overextend, not with wage growth slowing and mortgage resets looming. And if you're selling, you need skill, not luck. Today, in some areas, 2 in 10 listings are actually selling. That means 8 out of the 10 aren't moving. You need strategy, you need sharp pricing, and you need negotiation skill, period. And if you're buying and selling in this market, it's relative. It's a relative transition. And if you're an investor, watch rental trends closely. Remember that, because more purpose-built rentals are coming. Yes, population growth is slowing, so that means pressure on rents. And it can definitely impact your cash flow in this inflation hedge environment. This isn't all doom and gloom though, because here's the upside. The market is filtering out fluff. This rate cut is not a green light, it's a yellow light. You have to slow down, you have to assess, then act with clarity. Because the real estate price insanity had to stop and readjust because it just wasn't realistic. And if you have any questions about the Greater Toronto Area, we would love to hear from you. Thank you so much for watching. If this helped, hit subscribe. It helps more than you know. And we'll see you in the next episode. Bye for now.